Welcome to This Explainer. Today, we're doing something a little unconventional. We're putting a clinical stage biopharmaceutical company, Vir Biotechnology, through the ultimate valuation stress test. We're going to act as expert investment analysts to see exactly what happens when a cash-burning, high-potential biotech meets the most rigorous, old-school value investing frameworks in the world. Here's our roadmap for today. We'll start with a quick company snapshot, run it through the legendary lenses of Buffett, Lynch, and Graham, look at some DCF and alternative models, and finish up with our final recommendation. Let's get into it.
Section 1. Company Snapshot, Vir Biotechnology.
Vir Biotechnology trades on the NASDAQ under the ticker VIR, right around $9.40. That gives them a market cap of about $1.59 billion. So what exactly is their core business? Well, they're a clinical stage company focused on powering up the immune system to tackle serious infectious diseases, think hepatitis delta, and developing advanced T-cell engagers for solid tumors using their proprietary Pro-XTEN platform. Now, if you're a biotech investor, you already know these are the kinds of massive targets that can absolutely make or break a portfolio.
But honestly, the absolute centerpiece of our valuation today is their balance sheet. Just look at these current assets. They ended Q1 2026 sitting on $809.3 million in cash, equivalents, and investments. And get this, that actually excludes another $315 million from a recent collaboration they were set to receive in Q2. For a company valued at $1.59 billion, that giant pile of cash is the absolute anchor of our analysis.
Section 2. The Buffett Lens, Strict Value Investing. So, viewing VIR through a pass-fail checklist based on Warren Buffett's core philosophy, we immediately see the stock struggle against traditional value metrics. You know Buffett looks for a proven economic moat, right? Well, while VIR's Pro-XTEN masking technology definitely has huge potential, it's still clinical stage. That makes the moat highly speculative. Plus, the stock fails hard on return on equity, sitting at negative 13.94%. Management quality seems solid and debt is highly manageable. But when we look for consistent earnings and positive owner earnings, we just hit a brick wall. Q1 2026 alone saw a net loss of $125.7 million. So here's the crucial takeaway. Buffett requires a margin of safety built on predictable, consistent cash flows. With no consistent earnings and heavy R&D cash burn, there's just no margin of safety here under his strict rules. If you play strictly by Buffett's framework, his buy price for VIR is a firm $0.
Section 3. The Lynch Lens, High-Risk Turnarounds.
Now, under Peter Lynch's categorization, VIR isn't a stalwart or fast grower. It falls squarely into the asset play or high-risk turnaround bucket. We actually have to completely ignore his favorite metric, the PEG ratio, because VIR has a trailing EPS of negative $3.13. Instead, Lynch would focus obsessively on that balance sheet we mentioned earlier. More than half of VIR's market cap is backed by pure, tangible cash. And as we know, Lynch absolutely loves it when insiders or smart money are buying in. And this next point brilliantly illustrates the exact institutional confidence Lynch looks for. Astellas recently signed a $1.7 billion collaboration with VIR for their prostate cancer program. As part of that deal, Astellas made a $75 million equity investment, scooping up shares at $10.36. At the time, that was a 50% premium. Because of this strong balance sheet and that massive institutional vote of confidence, Lynch would likely view VIR as a really compelling, albeit speculative, asset play. Section 4. The Graham Lens, Defensive Investor. Okay, let's run Graham's defensive investor checklist. VIR actually gets credit for adequate size here, boasting a $1.59 billion market cap. It also passes his strong financial condition test with flying colors. Current assets massively outweigh its $73.5 million in current liabilities. But in stark contrast, it completely fails the earning stability and dividend tests. Graham demands a long history of positive earnings and a moderate PE ratio, and VIR just doesn't have either of those yet. And when we try to calculate Graham's intrinsic value using his famous formula, the square root of 22.5 times earnings per share times book value per share, the math literally breaks down. Because the earnings per share is negative $3.13, you're left trying to find the square root of a negative number. The formula yields an undefined value. To Benjamin Graham, a stock without current earnings power offers exactly zero margin of safety. He simply wouldn't touch the stock at any price above zero. Section 5. DCF and Alternatives, Forward-Looking Models.
since VIR currently has almost zero organic revenue, we have to make some pretty strong assumptions. Acting as analysts, we built a DCF model from scratch. We're using a high 15% weighted average cost of capital, or WACC, specifically to account for the intense risks associated with biotech clinical trials. For our terminal growth, we're using a standard 2%. To project free cash flows, we're relying on Wall Street consensus estimates of $248.9 million in 2026 revenue, which is driven largely by those massive $1.37 billion in potential milestone payments from the Astellas deal.
Let's pivot and look at some alternative models. VIR's enterprise value is roughly $1.2 billion. If we apply that 2026 estimated revenue of $248.9 million, we get a forward EV to revenue multiple of about 4.8. Now, for a biotech with pipeline blockbusters, that is incredibly cheap. Furthermore, the price-to-cash ratio is about 1.96. Think about what that actually means for your investment. You're essentially paying less than 2 times the cash they already have sitting in the bank, meaning you're getting all of their future scientific breakthroughs almost for free. And this right here brilliantly illustrates why Wall Street analysts diverge so sharply from those traditional value gurus. Utilizing these forward-looking models, analysts set an average price target of $22.33. Even the absolute most pessimistic analyst on the street has a target of $18, which is nearly double the current price. That average target, it implies an upside of over 137%.
Section 6. Final verdict. Synthesizing the data.
This summary perfectly captures the wild dichotomy of analyzing clinical biotechs. Rigid traditional frameworks value the stock at zero because of the current cash burn. But modern biotech valuation models, alongside Peter Lynch's asset play perspective, see a stock trading at a massive discount. With a cash runway extending all the way into late 2028 and a major validation from Astellas, the downside risk is heavily cushioned by their balance sheet. Ultimately, when we blend these frameworks, VIR stands out as a really compelling speculative buy for risk-tolerant investors banking on that $809 million cash runway and their oncology pipeline. Look, if you require current earnings, stay far away. But if you're willing to look forward, it leaves us to ask, does the promise of a cure and a fortress-like balance sheet outweigh the certainty of a cash burn? That is the ultimate question you have to answer. Thanks for joining this explainer, and we'll catch you in the next one.